Consider long call options. These financial instruments can be a powerful way to capitalize on your bullish outlook. But what exactly are long call options, and how can they benefit you? In the world of finance, it's essential to have a plan. A well-thought-out strategy can make the difference between success and failure. This is especially true when it comes to investing, where the stakes can be high and the market can be unpredictable. This is especially true when it comes to investing. Having a clear understanding of your goals, risk tolerance, and the tools at your disposal is crucial. One such tool is the long call option, which can be particularly advantageous in a bullish market. If you're feeling optimistic about a particular stock or the market as a whole, a long call option strategy might be right for you. This strategy allows you to potentially profit from upward price movements without having to invest a large amount of capital up front. This strategy is ideal for investors who believe prices will rise. By purchasing a call option, you gain the right to buy the underlying asset at a predetermined price, known as the strike price, before the option expires. It allows you to potentially profit from upward price movements. If the stock price increases above the strike price, you can exercise the option and buy the stock at the lower price, then sell it at the current market price for a profit. Essentially, a long call option gives you the right, but not the obligation, to buy an asset at a predetermined price, known as the strike price, before a specific date, the expiration date. This flexibility is one of the key advantages of options trading. Think of it as having a rain check for a stock. You have the option to buy it at a set price, regardless of how high the market price goes. This can be particularly beneficial in a rapidly rising market. If the price goes up, you can use your rain check to buy it at the lower price. This means you can lock in a profit by purchasing the stock at the strike price and selling it at the higher market price. If the price goes down, you can simply let your rain check expire. You're not obligated to buy the stock, so your potential loss is limited to the premium you paid for the option. Long call options are a powerful tool for investors. They allow you to leverage your capital and potentially generate significant returns. However, it's important to understand the mechanics and risks involved. They allow you to leverage your capital and potentially generate significant returns. By investing a relatively small amount of money, you can control a larger position in the stock, amplifying your potential gains. However, it's important to remember that options trading involves risk. The value of options can be highly volatile, and there is a possibility that the option could expire worthless, resulting in a total loss of the premium paid. You could lose your entire investment. This is why it's crucial to thoroughly research and understand the market conditions and the specific stock before entering into a long call option position. Before diving into long call options, it's crucial to understand how they work and the risks involved. Educating yourself and possibly consulting with a financial advisor can help you make informed decisions and develop a strategy that aligns with your investment goals. This guide will provide you with the basics to get started. By understanding the fundamentals of long call options, you can better navigate the complexities of the market and make more informed investment choices. One of the most attractive features of long call options is the defined risk. Unlike other investment strategies where losses can be unpredictable and potentially limitless, long call options provide a clear boundary for your financial exposure. Your maximum loss is limited to the premium paid for the option. This premium acts as a safety net, ensuring that no matter how the market moves, your losses are capped. This means you know exactly how much you stand to lose from the outset. This predictability is crucial for traders who want to manage their risk effectively and avoid unexpected financial pitfalls. Let's say you buy a call option for a stock trading at $100. This initial decision sets the stage for your potential gains and losses. The strike price is $110 and the premium is $5. This means you have the right, but not the obligation, to buy the stock at $110 before the option expires. If the stock price stays below $110 by the expiration date, your option expires worthless. In this scenario, you wouldn't exercise the option because it wouldn't be profitable. Your maximum loss is the $5 premium you paid. This is a small price to pay for the opportunity to potentially make significant gains. However, the potential for profit is unlimited. If the stock price rises significantly, the value of your call option can increase exponentially. If the stock price skyrockets to $150, you can exercise your option to buy the stock at $110 and immediately sell it for a profit. This difference between the market price and the strike price minus the premium represents your profit. This potential for unlimited gains while limiting losses makes long call options an appealing strategy for many traders. It allows them to participate in the upside of the market while having a clear understanding of their maximum risk. Long call options are primarily a capital gain strategy. This means profits are realized when you sell the options contracts themselves at a higher price than you paid for them. You're not buying the underlying asset outright. You're essentially betting on its price movement. For example, if you buy a call option for $5 and the price of the underlying asset increases, the value of your option will also increase. You can then choose to sell your option contract in the market for a profit. This profit is considered a capital gain. It's important to note that you can also profit from exercising the option to buy the underlying asset and then selling it at a higher price. However, this is less common as most traders prefer to capitalize on the increased value of the option itself. Contracts and shares. Understanding the relationship. When trading options, it's crucial to understand that each contract typically represents 100 shares of the underlying asset. This fundamental concept is the cornerstone of options trading and can significantly impact your trading strategy and outcomes. This means if you buy one call option contract, you have the right to buy 100 shares of the underlying stock at the strike price. The strike price is the predetermined price at which you can buy the stock, regardless of its current market price. For instance, if you buy one call option contract with a strike price of $50, you have the right to buy 100 shares of the underlying stock at $50 per share. This can be particularly advantageous if the market price of the stock rises above $50, allowing you to purchase the stock at a lower price. This relationship between option contracts and shares is important to consider when determining your position size and potential profits. Position size refers to the number of contracts you hold, and it directly influences your exposure to the market. Always remember that your potential profit or loss is multiplied by 100 for each option contract you hold. This multiplication effect can lead to substantial gains if the market moves in your favor, but it can also result in significant losses if the market moves against you. This leverage is a double-edged sword. Leverage allows you to control a large number of shares with a relatively small investment, but it also means that small market movements can have a large impact on your portfolio. It can amplify gains but also magnify losses. Therefore, it's essential to manage your risk carefully and understand the potential consequences of your trades. Always have a clear strategy and be prepared for various market scenarios. Timing is key. Knowing when to enter and exit. One of the most critical aspects of trading long call options is timing your entry and exit points. This involves analyzing market trends, identifying potential price breakouts, and understanding the time decay of options. A common strategy is to enter a long call position when you believe the price of the underlying asset is about to break out to the upside. This could be based on technical analysis, news events, or other market indicators. Exiting a trade involves similar considerations. You might exit when your profit target is reached, when the price starts to reverse, or when the time decay of the option becomes too significant. Theta decay, the silent threat to your options. Theta is a crucial concept in options trading. It represents the rate at which an option's value decays over time. All else being equal, an option will lose value as it gets closer to its expiration date. This decay accelerates as the expiration date approaches. This is because there's less time for the underlying asset to move in a favorable direction. To minimize the impact of theta decay, it's generally advisable to buy call options with a longer expiration date, ideally a few months out. This gives your trade more time to work in your favor and reduces the daily impact of time decay. Bringing it all together. Long call options in a nutshell. Long call options can be a powerful tool for investors looking to capitalize on rising markets. They offer the potential for unlimited profits while limiting losses to the premium paid. However, it's crucial to understand the risks involved and the importance of timing your entries and exits. Remember, options trading is not suitable for everyone. It's crucial to educate yourself thoroughly before making any investment decisions. Always consider your risk tolerance and consult with a financial advisor if needed. Thank you for watching, good luck with your trading, and do not forget to like and subscribe. See you next time.